I've looked at a few things. People remarked that my crazy efforts a while back were kind of interesting. Um, so maybe let's do that. And I think I'm going to be very mean. I was watching, I still want to get back onto Bloomberg. I've actually started watching a bit of it. What did I watch? So I was watching market surveillance on Bloomberg the other day. I think it was the 14th. It's now cutting it on Saturday, the 16th.
And joining us now is Ben Gutteridge, the investment director over at Invesco.
Ben Gutteridge over at Invesco, investment director. What is an investment director? We're going to look into Invesco shortly. What is an investment director? Why do we care? Who are Invesco? Why are they on TV? Why are we talking about them?
And wonderful to start the program with you this morning. Let's start here. What is there to like about the US equity market currently?
Ben, sorry, let me, as a capitalist, let me get that one. What is there to like about the US equity market presently? Nothing. But let's see what Ben thinks.
Well, I think quite a bit, actually.
Oh, wonder of wonder of wonder. A guy who peddles, a guy who needs AUM, thinks there's a lot to be said for US equities at the moment. Forgive me. Okay, but why? Why would the Fed go to like hold and more cautious? Presumably meaning, yeah, maybe the medicine is working. Why would that be conceived of being positive for equities? Because equities, if you will, have rallied for the pause. Why should the pause elicit a further pause rally? Don't get it.
You know, I think the backdrop is of resilient growth and a policy cohort that will probably decide to go on hold from here. That type of mix, resilient growth, more accommodative or less hawkish policy could fuel yet more gains in the US equity market. Of course, with all the other long-standing tailwinds for the US equity market, including sort of innovation and a place where shareholders can enjoy the spoils of that innovation as well.
Man, I'm sorry, but I mean, falling back upon innovation, US is a stock-friendly place to invest. Kind of doesn't crack the egg, my dear friend, when we're trying to justify why we should be committing allocations at this juncture.
Play like an Invesco every day. Are you literally making up the theories as you go? Or
are you literally making it up as you go at Invesco? I kind of like Invesco. The answer, I'm sure, will be refuted, but the answer is, oh, very definitely, yeah, we're making it up. We really do not have a clue. Not just, and that's not defamation to the good, honest, hardworking folk at Invesco. It's just a factual comment about this industry. Anyway.
Or is this actually finance and economics from our models of the past that we can use now?
Well, a fascinating reference doesn't come up much, but
Ben's going, who told you? Like, is there CCTV camera? How does he know?
But I mean, we're not making it up as we go along.
Oh, yes, he is making it up as he goes along.
Along at Invesco, I can assure you of that. But my job isn't so much making economic forecasts as investment forecasts. And if our view is that, rather than pinpoint economic forecasts, if the economy can be relatively resilient, coupled with policy that's, as I say, it would take a hike, take a pause on hiking, and so is relatively more accommodative. That's like a nice tailwind. I mean, recessionary risks do linger as we move into next year. They're quite material. But
he's completely lost it. He had a script. He was just not expecting to be blindsided by a bloody brilliant question. Again, well done, Bloomberg.
But for the time being, end of cycle stuff isn't such a bad period to be an equity.
How can the end of this cycle not be anything but a really, really bad period to find yourself honking on a lot of risk? Jeez.
Within your wheelhouse, and given what you just said about a resilient economy, does 60-40 work?
I mean, Tom Keane's not everyone's cup of tea, frankly, I think. the wheelhouse is spinning a little bit out of control. It's like bringing in your uncle and he just like, he goes up to your girlfriend and the girlfriend says, "Are you a virgin?" You're like, "Uncle." But 60-40 is the classic risk control mechanism. 60% equities, 40% bonds. The notion being bad things happen and bond prices will be negatively correlated. You have 40% in them and they typically go up, a la 2008. However, 2022 convincingly destroyed that. The problem being, if your bonds are profoundly overvalued, you don't have any risk. And what the majority of your risk managers, your pension fund managers discovered was they had no risk mitigation in the year 2022. They lost money partout, which is the French word for everywhere.
Well, I certainly think the 60 works.
Of course you do, Ben. I'm guessing you're an equity guy. Okay, so the 60% works. Again, let me just think about that because there are only 7 damn stocks which are going up. Okay, we look at everything else, nothing's really going up. So why does the 60 still work? I'm listening, Ben.
The 40 should do a bit better. I mean, clearly it's been a dreadful part of the portfolio for some 18 months. So
Ben, kind of, if you will, genuflecting to the catastrophe, which was the year 2022. I'm going to show you a chart in a minute. A chart that would speak to the, if you will, in, out, on, off with regard to 60-40, the return from bonds and versus the return from equities and the earnings yield. We'll come to
the maths of the bond component looks a bit more asymmetric. Looks like there should be a little less downside relative to the past. But also, you know, if we have this sort of disinflationary narrative and that the CPI report yesterday sort of supports the idea that it still is that the trends are still disinflationary ex shelter, but that should sort of come through. Leading indicators on rent suggest that the shelter component can come down. Then a disinflationary backdrop would be okay for the 40 as well. It would always encourage a little bit more diversification and alternatives and real assets and a bit of cash.
Bluster. I tell you, I would buy bananas from Ben down in the market, Portobello Road, but investment advice, I'm not so sure, Ben. Okay, let's look at that chart. Let's try and do Ben's job for him. Okay, so kind of what Ben should have said is like, okay, we put 60% in equities and 40% in bonds, and we hope. What we try and look at is we look at, what does this say? It says EY, earnings yield, not EV, electric vehicles. Cash yield, has, what does that say? Cash yield has historically led to equity sellers. Forget that. S&P 500 earnings yield minus the US Treasury 3-month yield. So the earnings yield, you take the earnings per share. I'm going to do an episode on why I never look at earnings. These TV shows are full of people quoting the earnings per share for the S&P. They're going up. I think the expectations are going to be up double digit next year is bonkers. I'll come back to that. But you take that earnings per share and you divide it by the level of the S&P, and that gives you a yield. And then you subtract it from essentially cash yield. So it's kind of, they're not comparable because cash has, I mean, it's nominal and it has no real protection, but your returns are definite. But again, definite only for the period of 3 months. Your equity return is real, so it's inflation protected and hypothetically is in perpetuity. Anyway, let's say the S&P, I don't know, what is it on? Is it on 22 times earnings? So what is the inverse of 20? You cancel 1 divided by 22. It would have an earnings yield of 4.5%. I mean, let's say it's on 20 times earnings. Okay, so it's got an earnings yield of 5%. Well, the 3-month Treasury yield kind of around about 5.5%. Okay, so what this is that presently you're negative. Okay, and the last time you were negative was at the height of the TMT fiasco, and you nearly got negative in the great financial recession, when the housing market imploded in 2007. A great time to buy was 6, 9 months, 12 months after this period, when the S&P was on its ass, which was March 2009. And some people would say to you that that was March 2009 up here. Yeah. Boom, 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 boom. Some people would say to you, that's because they started or they launched quantitative easing. Maybe. Or maybe it's because, like the treasuries today, you witnessed a 3, in fact, I'm going to say a 4 standard deviation. S&P was down like 2/3 from its high in 9 months. A 4 standard deviation correction in equities, and you had to buy it.
But not too troubled by a 60-40 portfolio.
I wish the great, amazing Ben had mentioned that, but he didn't. That's why you have your Patreon service.
Portfolio.
Ben, it feels like trading the end of a cycle is like dancing on the head of a pin.
Trading the end of the cycle feels like dancing on a pin. It is a sad day when you have to rely upon the presenters, the entertainers, the jazz singers at Bloomberg to come up with the wisdom. That's brilliant. That's brilliant. I'm going to use that. Investing at the end of the cycle is not like a sanguine, it's not like a really good time for taking risks. Ben, maybe you should be a presenter. I mean, I don't even think, Ben, you're good enough to be a presenter. Oh, that's unkind. Sorry, Ben. Sorry. I'm being cranky.
And how do you know when it's over, when the end of cycle season has just reached the end?
I'm losing the sunshine and I'm not liking the color here, but wait, how do you know when to leave the party? You never know, but sometimes it's prudent just to get the keys and leave.
Well, I mean, that's sort of the point. Is it's very difficult to know. So
for a moment there, I thought I was going to say, yeah, that's a $60 million question. Yeah, it's really difficult to know. You don't say, Ben. Ben, why are you on this show? Come on, give us your best shot.
So sort of swinging too defensively is there are some risks in that, and I think.
Whereas what Ben wants to say is, whereas being fully invested when your peer group are fully invested, there's really no commercial risk. This I saw this in the year. At the turn of the century, when NASDAQ turned and collapsed and it brought down like worldwide stocks. And the mutual fund managers, of which Invesco would have been a competitor, were furious because there was one long-only mutual fund, unit trust, Europe ex-UK manager who didn't lose money in the 2-3 years of the waterfall. Guess who that was? That was me. And it was really bad business for them because it was okay to lose 40, 50, 60, 70. It was okay. They thought it was okay to lose 40, 50, 60% of your money as long as the peer group, as long as everyone lost that money. But if there's some idiot, especially one with my accent that looks like me, and he ain't lost money, and the natives go, what's going on? You guys ain't explaining. And I want to say that actually led really to the re-emergence. Hedge funds had gone. Like hedge funds were an oddity, but the appalling performance of people like Ben and his cohorts, you can see they're still very, very to the fore. Clients went, I need a different strategy.
But if you're of the view that the recession, all recessions are obviously awful, but that this recession, the end of cycle event, might be relatively mild versus those more recent recessions.
Okay, let me repeat. So the Fed has never raised rates by this magnitude. It has never raised rates as rapidly as they have done in the last 18 months. Why? Oh, and let me put the other caveat. And either side of this, we had the pandemic, COVID, which has come. I would allege, my belief system leads me to believe that it has completely made wonky all of the crazy econometric models that the central banks and these guys have used and which have largely failed for 3 decades. Okay. So given all of that, why? Oh, and another thing, the guys, the Fed, were saying, yeah, but we kind of think this could be a bit of a soft landing. We don't want to say it, but we think it could be. These are the guys that said, yeah, transitory, no problem here. We're going to ignore it, and then boom, 10% price inflation. I think you're 15% in terms of year over year in U.S. import prices. I mean, this is the wrong crew. Why, Ben? Why would it be likely that the coming recession in US, remember, we're in a recession in China, we're in a recession in Europe. Why? Tell me why, Ben, is it going to be less severe in the United States?
Then that encourages you to be a little bit more overweight equities. Yes.
Oh my God. He is Invesco Investment Solutions. He's an investment director. I kind of want to almost stop there. I'm going to stop there. We should look at, can I find I mean, look at this is 20 years. We can do max. So Invesco, and we'll come back to who Invesco are in a second, it's trading at the same price as 1998. Now, I don't know if you can see me. I think you can. That is important. When people are telling you about inflation and buying equities, okay, what is Invesco? Invesco is an investment manager, would you believe? Let's read their website. Dedicated team, 8,400 people, 26 countries. So there's, oh God, I can't bear. Where's the Wikipedia page? Invesco. So, Invesco is a big investment name. They've got a ton of ETFs, actively managed funds. They manage pension funds, etc. Okay, so Invesco is trading $15. It's trading $15, people, in 1997. And this is something you got to keep in your mind. The world is broken. This is not inflation. This is inflationary assets. Asset managers would be one of the greatest businesses ever. You would be getting a fee on this perpetually rising, very rapidly rising asset class. You're creating inflation in your revenues, and you'd be paying away. Yeah, you'd have staff inflation, but this would be like owning a gold broker in the 1970s. It'd be cool. I mean, imagine that over that period. Let's put in SPY in a different world. So there is 1997. SPY was at 100. So the S&P's gone up 4.5 times, and Invesco is flat. Anyway, the point was, well, was there a point?